today's report, the 23rd of July 2025. So, what's in store for us today? I'll talk about the Q3 2025's earning outlook. Now, the overview first. The US equity market has reached a record highs in July, bolstered by optimism ahead of the Q2 2025 earnings season, which has only just begun. Right now, with key reports from major US banks and early bellwethers out, investors are receiving the first signals on corporate performance in an environment shaped by rising tariffs, fiscal strain, and evolving monetary policy expectations. Now, the key question: can the positive market sentiment persist as more firms report and forward guidance come under scrutiny? So what are early signs from the Q2 2025 earnings? So far, early Q2 results have generally come in above expectations, with solid beats from financials and selected large caps technology names. Now, financials have delivered solid earning beats. For example, Citigroup led bank surprises, and the sector overall benefited from high interest rates and improving credit metrics. Other financial firms like American Express have also beat expectations. Now, the large cap technology names like Taiwan Semiconductor, TSMC, posted a 60.7% net profit increase, well above expectations, and raised full year revenue guidance. Now, market expectations for S&P 500 earnings growth have been revised up modestly to around 5.6% year-on-year as analysts factor in stronger than expected performance from early reporters. Now, however, it is important to note that the bulk of S&P 500 companies will report in the coming weeks, and the early strength could be offset if companies reveal weaker guidance. Sectors with heavy exposure to tariffs and global supply chains, i.e. consumer discretionary, industrials, and materials, will attract close investors' attention. Now, so can the positive momentum carry through Q3 2025? The solid start to Q2 earnings season has kept market buoyant, but whether this momentum can persist into Q3 will depend on several macro headwinds. The very first one is tariffs. Trump administration aggressive tariff policies remained a wild card, while the market absorbed earlier tariff shocks thanks to a temporary 90-day pause. That pause is set to expire on August 1st. Tariffs on Chinese, Vietnamese, and select European goods have already increased sharply, raising the average US tariffs rate from 2.4% in 2024 to 19% as of late June. Now, these tariffs pose a stagflationary risk, raising costs for companies while potentially dampening consumption. Next is the Fed policy. The Fed is expected to hold rates steady at its July meeting, while markets still price in 2 cuts before year-end. Fed officials remain cautious given stricter than expected inflation and slowing consumer demand. Markets are hoping for a first cut in September, but the Fed is clearly data dependent and sensitive to inflation risk created by tariffs pass-through effects. Now, consumer resilience, consumption weakened noticeably in Q1 and early Q2 as households' savings fell below pre-pandemic levels and higher borrowing costs constrained discretionary spending. This could dampen revenue growth and lead to cautious forward guidance. Now, key macro themes shaping earnings and market sentiments. Both retail and institutional investors should closely monitor the following macro factors as Q2 earnings seasons unfold. First of all is the tariff, escalation risk, right? Industries with significant exposure to imports like auto manufacturers apparel, industrial goods face cost pressures that could compress margins. Now, US fiscal concerns with the deficit projected at around 5.6% of GDP and interest costs rising sharply, long-term concerns about US debt sustainability could lead to tightening fiscal conditions, impacting equity valuations. From the valuation context, right? The S&P is now trading at a 2 to 3% premium to Morningstar's composite fair value estimates, with growth stocks, particularly AI-related names, commanding much higher premiums than historical norms. In contrast, value stocks and small caps remain relatively undervalued. Okay, so these are the key macro themes. And the sector insights, which sector? Definitely financials. Early Q2 earnings beats have highlighted financial resilience. The sector's domestic focus, with just 28% of revenue from overseas, insulates it from much of the tariff fallout. Forward estimates are robust, with Q4 earnings growth projected at plus 38.4%, well above the market's 12.2% estimate. Now, for technology, tech continues to drive index gains, but valuation risks are rising. Energy and healthcare, both sectors are rebounding from recent weakness. Energy remains a potential inflation hedge, while healthcare's defensive qualities make it attractive despite some regulatory overhang. Small caps and value stocks still attractively priced, with small caps trading at 17% discount to fair value. Historically, this segment outperforms when rates decline and growth reaccelerates, a condition that may materialize later in 2025 or 2026. As a conclusion, outlook for Q2 earnings. From now we're at Q3, so look back what expectations of Q2 and beyond. While early Q2 earnings results have been reassuring and helped drive market optimism, the true test of corporate resilience lies ahead as reporting season accelerates and forward guidance adjusts to macro realities. So these are the key takeaways. Momentum from Q2 earnings reports may not fully carry into Q3 given tariff escalation risks, fragile consumer demand, and high market valuations. Sectors with low foreign exposure, example financials and defensive characteristics, example healthcare, are relatively better positioned. Now, expect greater volatility as the tariff pause deadline approaches on August 1st and as the Fed decides its next move in September. Okay, so that's the report for today.